Hello and welcome to the Hoover Institution's 2014 Spring Retreat. I'm Chris Dower, Hoover's Director of Marketing and Strategic Communications. Our speaker in this chartcast is Stephen Haber, the Peter and Helen Bing Senior Fellow at the Hoover Institution and the A.A. and Jean Welch Milligan Professor in the School of Humanities and Sciences at Stanford University. The title of his presentation is Fragile by Design: The Political Origins of Banking Crises and Scarce Credit, and it was recorded on May 5th, 2014.
Thank you, Stephen, for that very gracious introduction. I'm delighted to be here and to talk to you about a book which came out of the Denault Task Force on Property Rights, Freedom, and Prosperity. So I believe every book should start with a puzzle. And the puzzle that Charles Calomiris and I addressed in this book is, if stable and efficient banking systems are so good for economic growth, why do we see them so rarely? And we started by just gathering some data. This actually comes from data from the International Monetary Fund, and it's the frequency of bank crises over the last 40 years by country. And by crises, we mean a crisis large enough to take down the entire banking system. Not just one or two banks failing, but these are crises which threaten the existence of banking systems. And what the data basically show is that the number of countries that have not had a systemic banking crisis since 1970 is a tiny fraction of the world. Only 29% of the countries in the world over the last 40 years have not suffered a systemic banking crisis. 53% of the countries in the world had at least one crisis. And in red, you'll see 18% of the world had two or more crises. So we asked, well, who are those countries? And it's the rogues gallery you would usually expect. Places with really bad governance, such as Argentina, which has had 4 crises since 1970. They claim to have the world's lead on doing things wrong, followed by the Democratic Republic of the Congo with 3, and then another group of countries you'd expect to see there: Chad, the Central African Republic, Cameroon, Kenya, Nigeria, the Philippines, Thailand, Kenya, Nigeria, Turkey, Bolivia, Ecuador, Brazil, Mexico, Colombia, Costa Rica, Chile, Uruguay, Spain, Sweden, and the United States. Which led us to ask the question, what was the United States doing in this group of countries that included Argentina and Chad? Now, the standard explanation for crises is that they're caused by shocks that no one could imagine. I call this sort of the Tim Geithner view of explanation for crises. Well, there's these unforeseen shocks. No one could have expected them. We did the best we could. We were overtaken by events. Well, of course, if that's true, then you would see this group of countries should be a random selection of the planet. But it's not. And in fact, if you compare the United States and Canada over the last about 140 years, you'll find that, so let's just be clear here, that the United States and Canada, it's not like we didn't know what they were doing and they didn't know what we were doing. We've had, since 1840, 12 systemic banking crises. In the 19th century, we had one roughly every decade. Canada has had none. So when I've given this presentation in Canada, I've explained to them, see, we beat you again. They also find that funny, and Canadians are not known for their sense of humor. Now, this is particularly interesting because Canada is a shock-prone economy. It's an open economy. It's a natural resource exporter. If anybody should be getting hit by shocks externally, it's the Canadians. And in fact, they do get hit by shocks externally. But their banking system has weathered every one of those shocks, including the Great Depression, without the need for massive government intervention to save the banking system. So now our interest, as Charlie and I were working on this book, was really piqued. All right. So if it's not the sort of what I call the Tim Geithner view of banking crises, we're overtaken by events, Well, when do systemic banking crises occur, large-scale crises? Well, you have to go back to fundamentals. Systemic banking crises occur when two things happen simultaneously, and they must occur simultaneously. First, there has to be high levels of risk on bank balance sheets. If banks make solid loans to solid borrowers, those loans don't go bad. Second, there has to be inadequate capital backing those risks. So when a bank makes risky loans to more risky borrowers, but backs those loans with capital that's meant as a buffer should those loans fail, the bank will lose money. Shareholders will take a hit. But the government will not be required to step in to save the banks. So you have to have both of these things occurring together. The thesis of fragile by design is that the simultaneous occurrence of high levels of risk and low levels of capital is not a secret to regulators. You can see it. People saw it, in fact, leading up to the subprime crisis. It was not a secret amongst regulators in the United States. The implication is that that situation of high levels of risk and low levels of capital is the product of a purposeful political deal amongst a subgroup of politicians, bankers, and debtors. That bargain is about the creation of what economists call rents and their distribution amongst the three groups. Politicians are getting votes. There we go, we're back. Politicians are getting votes. A certain group of debtors is getting privileged access to credit or special access to credit. And bankers are getting some privilege in exchange for this, for doing this. That privilege generates for them returns above normal, or it generates for them a safety net should things go wrong, so that the downside risk to them is low. The goal of this group is to distribute rents amongst themselves, not to cause a crisis. However, the bargain that they make makes a crisis likely. It exposes everyone else to losses. And it makes a crisis likely because you're going to give loans to people who would not be able to get them otherwise under terms they couldn't get them otherwise. And what banks are often going to want in exchange is a special privilege, for example, to back those loans with low levels of capital. And you'll then put a safety net. The politicians will vote for a safety net under the banks such that depositors will get bailed out and everybody else will get bailed out when this thing fails. Now, what I've just described to you sounds kind of complicated. And that's the point. Precisely because these are complicated bargains that involve implicit deals, and they are not transparent, and they often involve unlikely partners, particularly bankers and groups of debtors. And we'll see in a minute what this actually looks like in the real world, looking at the United States. Because of all these factors, unlikely partners, a complicated deal, it's not transparent what's going on, it's really hard for the public to see what has taken place in this bargain. Now, it's very hard. One of the other theses of our book is that it is very hard to prevent these bargains from taking place. There are a few places on the planet where it is hard. One of them is Canada, and we can come back to that in Q&A. And it has to do with the peculiar nature of the political institutions of Canada. But for most countries on the planet, these deals are very hard to prevent precisely because governments need banks and bankers need governments. Think of the inherent conflict of interest that governments have towards banks. They simultaneously borrow from them and regulate them. That gives them an incentive to set the regulation such that banks will be likely to lend to government at under terms that suit the government. Second, banks or governments enforce loan contracts. They rely on the police power of the state to repossess collateral. But nobody votes for the guy that just threw him out of his house and padlocked the door. That is, debtors are voters. And so there's an inherent incentive for governments during a crisis to push banks to forgive debts. Third, governments are in charge of liquidating failed banks and allocating the losses. But they rely on the political support of depositors. Nobody votes for the guy that just told him the bank failed, your life savings are lost, and there's nothing we're going to do about it. Because those inherent conflicts of interest, it's very hard to get government out of banking. In fact, one of the things we do in this book is go back in history and show how almost all the early banks that develop around the world, that is the commercial banks, are created as government financing vehicles. This even includes in the United States in the early republic. Okay, so what do we do in this book? We actually look at what happened in 5 countries from the 17th century to the present. That's why the book, those of you who picked it up, is quite heavy. I like to say that this book took 4 years, 200,000 air miles, and 10 pounds. My wife, who's sitting in the front row, does not think the joke about the 10 pounds is funny. What we do is we look at the coalitions that form, sort of the basic fundamental institutions of countries, the coalitions that form around bank regulation. Who is in favor of inexpensive credit? Who gets a bank charter? Which political groups support it? That is what the deal is. And we look across countries and across time. We focus on 5 countries: England, Canada, the United States, Mexico, and Brazil. And we look at those countries for 2 reasons. First, they show variance within time in their political institutions. And second, they show variance across time in their political institutions. And third, actually, the last 2 have good beaches. Actually, the truth of the matter is I didn't want to write about any country where I don't actually speak the language fluently. So I don't speak French well enough to even order in a 2-star restaurant, so we decided to focus on Mexico and Brazil. Okay, so that's what we do. So now, obviously, there is not enough time for me to explain to you everything in this 624-page book. Okay, I thought that was funny. So I'm just going to talk about the United States for the next 10 minutes or so and give you a sense of how politics has shaped bank regulation, the structure of the banking system, and the propensity to crises in the U.S. over the last 200 years. So we all remember Alexander Hamilton and how he created the Bank of the United States and designed a system that was meant to both provide finance to manufacturers and support for the federal government. What we usually don't get taught in high school is that this system only lasted 20 years. Hamilton's Bank of the United States was not renewed in 1811 when it came up for renewal. And what happened instead was that a coalition of populist politicians representing farmers who did not like big city people and big city corporations made an alliance with small town bankers who did not want to have to compete against big, robust, branching banks. They fought state house by state house because bank regulation in the Constitution, it says nothing, in fact, about banks. And so that meant state governments had the authority to make the rules. This coalition fought state house by state house, and they created a system unlike the system of any other country on the planet. They basically created a system in which it was illegal for banks to own branches. That system, so what you basically had were local monopolies operating in individual towns around the country, That local banker, since computers hadn't been invented yet, everything he knew about his borrowers, he knew from local information. That meant he lent locally or to no one. What did this system then look like? Well, here's the United States banking system in 1920. This is 110 years after the death of the Hamiltonian system. The sort of bluish-purple line, I'm sure there's a more correct name for that color, is the number of banks. There are 27,000 banking corporations in the U.S. in 1920. The red line, the red block you can see on the right, is the number of branches owned by those banks. This isn't the number of branches per bank. That's the total number of branches. This is a banking system, essentially, that has no branches. In fact, up until 1970, only 12 states in the United States permitted banks to open branches within their borders without restriction. Many states had restrictions, for example, only allowing branching within a particular county. Some states, such as Montana and Texas, did not allow branches at all. Now think about who gains and who loses from this system. Well, if you're a local banker, you've got a local monopoly. You gain. This is why the joke up until the 1970s was banking was a 3-3-3 business. You pay 3% interest on deposits. You charge 3% more interest for a loan, and you're on the golf course by 3. So small-town bankers won. Prosperous farmers win too, because the banker lends to them or to nobody. Who loses? Well, everybody else who might want a loan, including large-scale manufacturers who are having to go to these tiny banks that can't possibly finance their enterprises. Now, there's another group that loses. It's depositors. Why? Because every 10 years, this system failed, like clockwork. Why? Well, 2 simple reasons. First, a banking system without branches cannot move funds from branch to head off runs. Second, a banking system without branches cannot spread risk across regions. So if the crop fails in that local district where that monopoly bank is, that bank goes down. And in fact, that run on that bank sets off a run on the next bank and the next bank and the next bank, which is why the United States in the 19th century, that is actually all the way up until 1932, has the most crisis-prone banking system on the planet. Now, I don't have time to go into this, but the Federal Reserve is created, in fact, to prop up the system, and the Glass-Steagall Act is created to prop up this system. One of the things that people usually forget about the Glass-Steagall Act of the 1930s is that it made it illegal for banks to pay interest on checking accounts through Regulation Q, and it instituted government-run deposit insurance. We're the first country on the planet to have done it. One of the other things people forget about the deposit insurance story is that even FDR was opposed to it. And he's opposed to it for sound economic reasons, because it removes the incentives of depositors to police bankers. So this inherently inefficient system and this inherently unstable system exposes depositors to losses and exposes the economy to these big shocks as the banking system periodically crashes. What is really interesting about that system is how long it lasts. So this is the x-axis here is time from 1920 to 2010. Red is the number of banks. Blue is the number of branches per bank. And you'll see that it is not until the 1980s that the typical bank in the United States has more, on average, than 4 branches. The Bank of America, which now has an ATM, any place they can find 6 square feet of space to rent, is at that time, circa 1970, a California-only bank that's shedding branches. What sustains this system? Well, a set of federal regulations that create deposit insurance so that people don't have incentives to put their money into more sound institutions, state laws against branch banking, and Regulation Q, which doesn't allow bankers to compete on the basis of the interest they'll pay on deposits. I think everybody in this room is old enough, therefore, to remember the peculiar structure of competition of banks in the 1960s and 70s, in which if you opened a checking account, they gave you a stuffed animal or a clock radio for a really big deposit. Imagine that. The mightiest country on earth had a banking system that competed on the basis of Crocker dogs. What undoes this? Well, it's not four-sided regulation. There's two things that sustain it, and they both start to disappear in the 1970s. The first is a system in which you can't pay interest on deposits is a system that requires low levels of inflation. Once inflation takes off because the Johnson administration and the Nixon administration decide to simultaneously fight the war in Vietnam and the war on poverty, interest rates in the banking system turn negative and everybody gets their money out. The second thing that undoes it is technological change. The invention of the computer, which meant that bankers can now observe depositors at a distance, and depositors are able to use what the unit bankers call an evil and wicked invention, the ATM. In fact, small-town bankers go to court against big bankers saying that the ATM is in violation of state laws against branching. It's not till 1985 that the Supreme Court rules that an ATM is not a branch. Now, so you can see number of banks beginning in the 80s. So all this leads us into, I don't have time to go into this, leads us into the savings and loan crisis of the 1980s, where against high inflation and increased competition, small bankers start throwing Hail Mary passes. They rarely work in football. They didn't work for the bankers. We get a big shock. That is, we get a big collapse in the 1980s. And state governments and the federal government look at the situation and say, oh, we don't want to have to bail out all these small-town banks and satisfy the depositors. Let's just let bankers start to cross state lines, and let's relax our restrictions on branching so that big banks can, more solvent, larger banks can buy smaller banks, and anti-branching laws go away. Okay. Now, so we start to move towards a system characterized by large banks with branches. Well, that should have made the system more stable. But if that's true, how'd we have a subprime crisis? Okay. There is now another unlikely partnership. Remember, the partnership of the 19th century is populist politicians, small-town bankers, and prosperous farmers. The new partnership is banks trying to grow large enough so that they're too big to fail, and urban populist politicians representing urban areas wanting to get cheap credit for their constituents, and politicians who see this as a way to generate political support and votes, and to deal with the inequality problem off balance sheet, that is, not within the federal government's books. And so one of the things we do in the book is spend a lot of time going through the hearings of the Federal Reserve, because the Federal Reserve has to approve every bank merger. And they're supposed to be looking at a set of criteria, one of which is, will the bank have too much market power? That consideration is thrown aside. And the thing that they overwhelmingly focus on is whether or not the bank has been a good citizen as defined by the CRA Act of 1977, which was a well-meaning piece of legislation. Remember, back in the days when banks didn't compete, they didn't look very hard for high-quality borrowers in poor neighborhoods. Once you go to a system in which there's lots of competition amongst banks, well, then they're going to look for borrowers everywhere. And now the CRA becomes an important chip in this game. And so these are two quotes, one from the head of Acorn Housing, and the other from the head of the Neighborhood Assistance Corporation of America. These are both activist groups, left-wing activist groups that are advocates for the poor. And they're testifying at the Federal Reserve Board hearings around the creation or the merger of Nations Bank and Bank of America in 1994. This creates the largest bank in the United States at the time. And what's shocking is, here's the president of Acorn Housing. We support the Nations Bank acquisition of Bank of America because they will make credit work for low and moderate income people, and they will work with community institutions, meaning they're going to channel credit through us. Here is Bruce Marks, CEO of the Neighborhood Assistance Corporation of America, someone who, incidentally, is always accusing banks of being predatory lenders, and who you would have thought would have opposed the creation of a mega bank that was too big to fail. Quote, the ability to purchase a home with no down payment, no closing costs, no application fee, no perfect credit, at less than 7% interest is incredible. The regulators need to approve the application immediately. Now, because the opportunity cost of my time is very low, we spent months reading all of these transcripts. They are a circus. They go on for hundreds of pages. It is amazing who shows up at these Federal Reserve hearings to testify, including Barney Frank, Jesse Jackson, the Reverend Al Sharpton. It is unbelievable. Okay, I need to move quickly so we have time for Q&A. What are the activists getting? They are getting explicit, written, contractual agreements that the merging banks are going to channel credit through those activist groups. How do we know this? Because the activists themselves put together a data set for us. They didn't put it together for us. They put it together for themselves, and then they put it online. And we found it, and we simply downloaded the data. So this is their data. And what it basically shows is the cumulative value of those commitments by merging banks to activist groups came to $867 billion between 1977 and 2007. And in fact, almost all of that is occurring here at the end. That is, it's all post-1990s. And that's a lower bound estimate because there's a lot of credit going through activist groups that are not in those commitments. The total number is about $4.6 trillion. Now, banks are not in the business of making loans with zero down payments at low rates of interest with no closing costs. That's not their business model. They're in the business to make money. So this game can only work if the banks can move those loans off their balance sheets. Who are they going to move them to? Well, they're going to sell them to Fannie Mae and Freddie Mac, of course. Fannie Mae and Freddie Mac don't want to buy them. For good reason, because their shareholders are also not in the business of making loans to people who otherwise would not get a loan and are likely to default. And so in 1991, I'll skip ahead here, Acorn is invited by the Senate to testify against Fannie and Freddie. And this is from George Butch's testimony. I'll read it because I always marvel at this. It is Acorn's observation that the underwriting criteria employed by Fannie and Freddie have been developed not for the general mortgage market, which includes low and moderate income homeowners, but the middle income and substantially suburban. Okay. As a result, it is our firm belief that the underwriting standards dictated by the secondary mortgage market are at a minimum income discretionary and may, by extension, be racially discriminatory. Wait a minute. I thought banks were supposed to discriminate on the basis of income when you apply for a loan. Last time I applied for a loan, they asked me how much money I made. If John Raisin were here, I'd ask him for a raise. Okay. Fannie and Freddie have to have their arms twisted behind them in legislation signed into law by George H.W. Bush a week before the 1992 election. There are repurchase mandates set for them that escalate from 1992 all the way through 2007 that require them to dedicate a portion of their portfolios to what are called low and moderate income, which is below the mean income, special affordable, which are very poor borrowers, and underserved, which are urban areas. When you put it all together, by 2007, something on the order of 3/4 of all Fannie and Freddie loan purchases are being made in these mandated categories. And the other point I want to make about this political coalition in its power is that it starts in the George H.W. Bush administration. It's then supported massively by Bill Clinton. And then it is supported also by George W. Bush, who increases the mandates yet again. This is a this is bipartisanship. Okay. Now, and here I'm going to wrap up. Fannie and Freddie can't have one standard for one group of borrowers and one standard for everybody. They have to knock down the underwriting standards for everybody to make this work. And so by 2007, 40% of all loans are being made to borrowers who put down less than 3%. In fact, a survey by the National Association of Realtors in 2006 showed that 46% of all first-time home borrowers put no money down at all. One of the things that had to be done to meet these increasing mandates, in fact, was that Fannie and Freddie had to agree to get rid of or to stop restricting no-doc mortgages. They started to buy them without limit. And one of the things we have in the book is we have all the internal emails from within Freddie, where the risk managers are saying, this is a terrible idea, we shouldn't do this, and their bosses are saying, we have to. This is politically required. And so they fire the risk managers, one of whom is now teaching middle school math in Prince George's County. Okay. What do Fannie and Freddie get? They get very low levels of capital requirements, about half that of commercial banks. And by the sort of ability to create a mortgage-backed security and sell it back to a bank, that means that banks also get the same low capital requirements. And so there's a lot of banks that go into the business of generating mortgages to people they know have a low likelihood of repaying them, selling it to Fannie and Freddie, buying that set of mortgages back as a mortgage-backed security that they can now hold in their portfolio at only with only 2% capital. There's a capital buffer of 2%. Well, so now we have lax lending standards, we have higher levels of risk, and we have low levels of prudential capital. Okay, we know what happened. So the blue line is the percentage of mortgages in arrears in the United States. By 2007, by 2008, it hits 11%. The green line on the bottom, that's Canada. Will Dodd-Frank protect us? I want to leave time for Q&A, so the answer is no. Why write a book? Because whoever frames the debate wins the debate. Framing a debate requires a logical framework and the relevant facts, and those facts must stand up to scrutiny. This is a scholarly, not a journalistic enterprise. And that means that Hoover is well positioned to be in the business of framing debates, unlike any other think tank, because Hoover can leverage its resources via task forces because it is embedded inside a university. This book would not have happened had there not been the property rights task force that was organized by John Razian and funded by the Denaults. And so I'd like to close by thanking both the Denault family and John Razian for organizing that task force and for supporting it. Thank you.
I'm Chris Dower for the Hoover Institution. Thanks for listening. For more information about the Hoover Institution, please visit hoover.org.